All right, let's get right into it. Today, we're going to tear down a professional framework for picking stocks. We're talking about a system that takes a whole list of supposedly undervalued companies and puts them through an absolute gauntlet to find the real winners. This is all about separating the hidden gems from well, the junk.
So, here's the game plan. First, we're going to tackle the big problem with so-called undervalued stocks. Then, I'll introduce you to this really powerful framework that's built on the ideas of 3 investing legends. After that, we'll actually run our stocks through the gauntlet, reveal the top 5 that survived, and then wrap up with the single most important lesson from this whole thing.
Okay, let's set the stage. You know, the biggest challenge for any investor isn't just finding cheap stocks. Nope, it's finding cheap stocks that are actually good businesses.
So imagine this for a second. You get a list of companies that some algorithm or analyst has flagged as undervalued. Great, but which ones are the hidden treasures and which ones are just, cheap for a very good reason? That is the billion-dollar question we're digging into today. Our journey starts right here. This is our initial lineup, 20 companies pulled straight from some undervalued reports on the NASDAQ and Dow Jones. Now, don't worry about trying to read them all. We're going to focus on the important ones. But you can see it's a real mix, right? We've got huge names like Nike and Johnson & Johnson right next to some you might not know. This is the raw material we're about to put to the test.
Now, to filter a list like that, we need some serious tools. So we're not just making stuff up, we are borrowing from the absolute best. We're using a framework built on the core philosophies of 3 legendary investors.
First up, we've got Warren Buffett's test, and this is all about quality. He's famous for looking for companies with a strong economic moat, basically a durable competitive advantage that keeps all the rivals away. Think of a powerful brand or a key patent. But he also has a hard number, a consistent return on equity, or ROE, of over 15%. Just think of ROE as a profitability score. It means for every dollar the shareholders have invested, the company is making over 15 cents in profit. That's a sign of a really, really efficient business.
Next, we bring in Seth Klarman, who is absolutely laser-focused on value. His whole thing is the margin of safety. What this means is you only buy a stock when it's selling for way less than what it's actually worth, its intrinsic value. For our filter, we're looking for a big discount, a stock that's trading at least 30% below its true value. It's literally like buying a dollar for 70 cents. And finally, we have Peter Lynch's check. Lynch was the king of finding growth at a reasonable price. His secret weapon was something called the PGY ratio. It's just a clever way of asking, is the company's growth rate, plus the dividends it pays out, higher than its price tag? If that final PGY number is under 1.0, it's a huge signal that you're getting a whole lot of growth for the price you're paying. A potential bargain for sure.
Okay, so we've got our list, and we've got our framework from the masters. Now for the fun part. It's time to run these 20 companies through the gauntlet and see who actually survives. So who's a star performer? We'll take a look at Johnson & Johnson. It absolutely crushes this test. I mean, look at these scores. A 9 out of 10 on Buffett's test for its quality and moat. Another 9 on Klarman's margin of safety, which means it's cheap. And a super solid 8 on Lynch's growth check. With a total score of 26, this is pretty much the textbook definition of a high-quality, undervalued company.
Now for the complete opposite, let's look at IBM. Even though it was on that initial undervalued list, it just completely falls apart under real scrutiny. A 3 for its moat, which is really struggling these days. A 1 for value, turns out it's not actually cheap, and a big fat 0 on Lynch's check because, well, there's no growth. This shows you exactly how the filter separates true value from what we call value traps.
Let's just put them side by side for a second. The difference is just stark. J&J is trading at a real 27% discount and has a powerful protected business. IBM, on the other hand, is found to be 56% overvalued compared to what it's actually worth, and it's stuck struggling to grow. This is exactly why you need a multi-layered approach like this.
So after putting all 20 of those companies through this really tough process, an elite group emerged. Let's go ahead and reveal the top 5 champions that actually made the final cut.
So it's no surprise that our number 1 champion is Johnson & Johnson. As we just saw, it was the strongest scorer overall. It just perfectly blends Buffett's need for a high-quality moat with Klarman's demand for a deep discount. It's the best of both worlds, amazing quality and great value.
Coming in at number 2 is AbbVie.
This company is a pharmaceutical powerhouse, and it really acts as a kind of defensive growth engine. Its moat is incredibly strong, all thanks to its dominance in these high-margin, recession-resistant areas like immunology.
Number 3 is a really special one, Berkshire Hathaway itself. Peter Lynch would have called this a classic asset play, where the market just doesn't see the true value of all the amazing businesses it owns. As the source analysis put it, it's the quintessence of the Buffett method, a business where even a dummy could make money in.
Now, AT&T is fascinating because it's a pure, deep value play. I mean, check out the numbers. AT&T's price-to-earnings ratio, a basic measure of how expensive a stock is way down there around 8. Compare that to the industry average, which is up at 16.2. You're basically getting this stock for half the price of its competitors. That is a classic Seth Klarman bargain right there.
And rounding out our top 5 is Nike. Nike fits perfectly into a category that Peter Lynch called a stalwart. This is a massive, stable company with an absolutely unrivaled brand moat, and it just keeps delivering steady 10 to 12% growth. It's a reliable, defensive company with a very, very low chance of ever going away.
Okay, so we found our top 5. Awesome. But what's the big picture lesson here? Well, it's all about the incredible power you get when you combine these different expert frameworks into one.
You see, this final portfolio isn't just a random list of good stocks. It's a carefully balanced machine. You've got the high-quality moats that Buffett loves, the deep value discounts that Klarman insists on, and the steady, reliable growth that Lynch looks for. By combining them, you create a portfolio that's designed not just to grow, but to be resilient. It helps protect you from buying junk while still letting you capture real opportunity.
And all that leaves us with one final thought. We've seen how these 3 really distinct philosophies, quality, value, and growth, can work together so powerfully. But if you had to pick just one, which investor's rules would you trust most with your own money? It's a great question to think about as you start to build your own approach.